Sure. I don't care. If one of you wants to come on, that's great. Hi, everybody. We will get going in just a couple of minutes here. We're waiting for, and I think I see him coming. We got our co-host arriving in just in time.
Saved by the
So
bell.
yeah, always. That's how it always works. I don't even get anxious about it anymore. Chris, you are on mute though. And everybody, still have a bunch of people rolling in here, so we'll give it just another 30 seconds or so before we get started. There you are, Mr. Chris Perry.
Yes.
Yes, I can hear you. I just wanted to make sure I could hear you.
Good afternoon.
Good afternoon. All right, everybody, I think we're going to go ahead and get going here. This is the Last Week in Mortgage Today. I am Faith Howard Mooney from the Mortgage Collaborative. And thank you so much for joining us today and kind of getting a scoop on some of the things that have been happening in the last week. With me today, so lucky, I have Chris Perry, who is the National Credit Union Manager and VP of Sales at MGIC. Thanks for doing this, Chris.
Absolutely.
You want to share with everybody a little bit about, I know a lot of people in our network know you already, but want to share a little bit about what you do for MGIC and kind of what your expertise is there?
Sure. So I've been in the mortgage industry since 1990. Ouch. Hard to believe. Time goes so quickly. I've been with MGIC for the last 24 years and for and all in client development sales. And for the last close to a dozen years, I've led our approach towards the vertical market of credit unions and a number of other things, but that's been my primary role. I still keep very much in touch with, I live in Northern Virginia, so DC is a hotbed of independent mortgage bankers. A lot of my friends that I grew up with now own and run large shops, so I still keep very closely tied to that world of mortgages, as well as the financial institution, the smaller financial institution world of mortgages. And they are quite different.
They are. And we have the whole broad spectrum of that here, but our kind of core tends to be small to mid-size mortgage lenders. Credit union space is our most rapidly growing space within TMC. So I always love to talk with you because you've educated me on a number of different things and truly appreciate that. But let's get going. So biggest news, of course, at the end of last week, Chairman Powell. I'm not quite sure where the phrase by the stars under cloudy skies came from, but I thought that was.
I think he was reading some poetry the night before, perhaps Robert Frost, maybe. I don't know.
Was it supposed to like soften the unknown of the statement, or I don't know. But it was very evident based on what it says is they're sticking with that targeted 2% number and going to stay there until the job is done.
Yeah.
And so I just don't know. I would love it if you would share. I'm not quite sure anything in this cycle has been how it has been in the past. We've both been in for a very long time. Would love for people to pop into the chat, kind of like how you feel about this. I'm not sure because every other number has been different about how this cycle, if you want to call it that, has worked. I'm not sure 2% is the right number. Share with me how you feel about that. Do you think that everything has stayed static and that number is always going to be the right number? Or is it something different?
You know, I personally, I've heard a lot of discussion of, well, maybe that number can move up some. You know, I think in large part it's almost unknowable even to our politicians and economists. I think they kind of pick that number, weighing a lot of individuals, you know, and their circumstances. So if you ask a economically challenged or family or elderly folks living on a very tight budget,
Income, yeah.
which may be that those two groupings could be as much as 45% of our society. 2% is probably too much, right? It,
Yeah.
it, it's painful to them, and where they've landed after it being for a year and a half higher than 2% is probably a really difficult spot. Whereas in people with higher incomes, 2% isn't all that critical. I think it'll come down to does does it stay in the below 3% range and get closer to 2, and then that's probably where the Fed will feel comfortable. But if it doesn't, then they're going to have to continue to raise rates.
Yeah. Yeah. And there wasn't any, I mean, it didn't seem like there really wasn't an answer about what's going to happen. It was kind of
Yeah.
an announcement that really wasn't a substantial announcement really of anything. So we're
If
all in it for the long haul.
if anything, it was, I think, even maybe more hawkish than was anticipated, but maybe the poetry language softened the blow because the market seems to have brushed aside any hawkishness and is rolling forward.
Yeah, I
The
know.
market being equities.
Yeah, it's like such a different environment than how it's ever been in the past that I don't think that anybody really knows exactly what to expect. But if anybody of you on this call, we want you to hop into the chat, give commentary if you have any feelings about that. Would love to hear from you as we kind of move on to talk a little bit more about housing. So I'm always interested in everything housing. I don't know if I'm the only weird person on this call, but I have been known to be on vacation driving through a neighborhood with Zillow on to see what houses are listed at. I always thought that that was just a strange obsession of mine, but then I found out that I have many other friends who do a similar thing.
Plenty of housing geeks.
Exactly. Maybe it's that appraisal side of the business that I was in that makes me want to do that and know the value. But as far as listings go and the National Association of Realtors total membership, 1.56 million announced this week. There are about 547,000 active listings, which when you figure out those numbers, which granted it doesn't include non-National Association realtors, they're not even included in the realtor number. 1 for 3, one listing for every 3 real estate agents.
Yeah.
I don't know. I guess in looking at that, I was like, well, what is going to happen to those people? And are they real estate agents that real estate is their full-time job? And they're, in the same spot of LOs that are trying to, generate their income from those home sales too? Or does that include people that maybe, it wasn't their full-time job? It made me worry about my real estate friends that I know related to that. What do you think's going to happen there?
I think a great number of those. It's a position that it's not a full-time job. It's supplemental income, so they have a lot more capacity to wait it out. Whereas the probably the 80-20 rule in agents is more like a 95-5 rule, where I mean, a large portion of those 550 active listings are with very active agents.
Yeah.
And if you think about it, I mean, I'm actually planning on selling my home next spring, and we're going to go with an agent grouping that's one of the most successful in Northern Virginia. We're not going to take a chance on somebody who does it, on a part-time basis, or they're actively selling I think like 10 homes a month, that team. So my own experience tells me that it's not going to change. There'll still be plenty of agents in the market that'll live through this desert period, and the strong ones will get even stronger.
Yeah. I tend to agree and do have that same perspective here in the Twin Cities that I think, there's a group that that are very active and working and you see them out at other events and in communities and stuff. Um, it makes me wonder whether some of the people that aren't included in that group, it's like, do they have secondary income somewhere? Are they people that are, working some of those other flexible jobs that people sometimes have out there in this interim period of time? I would have to think that that was the case.
Some things in business are just unknowable. I'll use an example of to me, incredibly high percentage of business that we do as mortgage people with a 45 back ratio. Who can live on a 45 back ratio? I couldn't live on a 35 back ratio. And our, as a company, from a risk perspective, we look at it that and we say, all right, most of these people, if not all of them, have other income. Maybe it's a multi-family dwelling, or it's a spouse with credit issues, or they're renting rooms. But yeah, the percentage is just way higher than you could ever imagine without there being plausible explanation.
Yeah. And it is interesting. I was having a conversation with somebody this last week, and one of the comments that was made was that no loan is an easy loan right now. And I think that LOs and our lender members are seeing that, it's like it's not the standard, one or two borrower, one, income. It's like you're dealing with maybe two borrowers and five income, sources. And
Yeah.
so they're like, it's the vanilla stuff has went through the pipeline already and is gone. And the things that are left, you are going to be dealing with people that maybe are a little bit harder to qualify, have multiple jobs, maybe not full-time employment, but maybe multiple jobs stack up to full-time
Yeah.
employment.
And
And so,
home buyers, or maybe if not first time, maybe combining home buyers or returning home buyers. Yeah, that your typical purchase is sitting on their property and their 3% interest rate.
right.
Even if they want to sell, they're feeling, that giving up that rate would just not be prudent to move to a 7% rate.
Right. That's called, I learned that several weeks ago that they're calling that locked in, that people are locked in. They're feeling kind of trapped by their housing right now because of that very same issue, which I was at my pool a couple of weeks ago, and one of the families that was there that I was talking to said, we really want to move, but we're not going to.
So it's the
Um,
opposite side of love the home, not the mortgage. It's love the mortgage, not the home.
you go. There you go. Yeah, right now it does kind of seem a little bit that way. Well, I was doing some research on different things going on actually in housing and with the houses, and I came across an article that there are 3 states out there. I don't know how prevalent this is where you're at. For us, it's a little bit more prevalent when you get up into our lake country, but there are 3 states. We're not one of them, though, that they're actually paying for people to build essentially a tiny home. So ADUs, which people have talked about, accessory dwelling units, anywhere from 150 to 1,200 square feet. I'm not sure I could live in 1,200 square feet, and it's just, me and one other kid. But many people apparently are looking at this. North Carolina, California, New York all have special programs that they are either no property tax for tiny homes is North Carolina. California is paying some of the pre-development costs, so agricultural design, zone, soil tests, all of the things that are done in California. New York has one that they grant money to local governments or nonprofits to support low-to-mod buyers, which I think is always a good thing. And it's up to $125,000 to build or bring an existing house up to code. New York has set aside $85 million over the next 5 years. Vermont is the last one, where I would have to think that's much like Minnesota Lake Country,
Yeah.
where a lot of those homes are being built, and whether people are living in them permanently or they're being used as guest homes or people coming up to ski, that type of thing. So I just curious, I'm always curious because you're in a different market than what I'm in. Do you see any of this type of housing being built in your area, or know of anybody that has
You
dealt with
know,
that? Because I would have to think at some point in time, you're going to see some of those housing changes as
so
well.
I live in, as I mentioned, Northern Virginia, which most of the developments over the last 30, 40 years have, have planned unit development boards or community boards and guidelines that would not allow that. But I do know example up in, say, Montgomery County, Maryland, where you've got a good bit of older housing stock. Uh, that they are allowing those units to be legal, and so that's something that's occurred. And it's kind of interesting when you think about it. Like, there's pockets of New York State that multifamilies are just super common, when you wouldn't, you just don't see them around where I live. But downtown DC, that's been happening over the last 20 years, where many old homes get broken up into condo, 4 or 5 unit condos. So I definitely see all that as a trend that won't stop, because our inventory issues not going to go away. It's going to plague us for probably decades. Maybe some of the influences that are pressing on it right now, things like the economic uncertainty and people having really low rates, and I think high investor interest have added to the inventory issue. But just the fact that there are fewer current homes being sold and homes being built than the population wants and needs, is just not going to change. So
Yeah. And you just gave the greatest segue into something else that I ran across this week related to the DC market. So, and I'm thinking that we're going to see this more and more. So outside of DC, Montgomery County, there is a place called the Laureate, and it is an apartment building outside of DC. They have Montgomery County and the Housing Opportunities Commission of Montgomery County have invested essentially into this apartment complex. They have for-profit people that have come in. So it's a combination of government plus private, that they have come in, and Montgomery County has invested enough that they have a 70% stake in this particular housing development or apartment building, that they're trying to like marry the demands of supply versus subsidized housing. So what they've come in and guaranteed that 30% of the units within that complex are going to be affordable housing. So in the DC market, I have to guess that, cost of living high. It's a 15-minute, this is at a place where there's a Starbucks across the street. There is a train.
Montgomery County is often within the top 10, 15 median income counties in the country. So it's a very wealthy county, and they've actually had that department for probably 30, 40 years. So they've always had an approach towards, if you want to build a subdivision as a builder, you've got to set aside a number of affordable housing units that the Montgomery County HSC provides loans for. Right? Obviously, there's limitations to of who can get that loan, and stipulations on they provide closing cost assistance, but there's also stipulations on how long you have to own that home. But they've always been very proactive in that process. I'm not going to say that that's a silver bullet. They still have a tremendous, uh, inventory issue in Montgomery County, like they do in any other,
Yeah.
suburban area, in the country.
Yeah,
But
I was kind
it
of just
helps.
impressed by their thought process because it is a little bit different than what I've heard of from other places, and that they're trying to marry like the two together to have an impact. So in this particular unit, um, or complex, $1,700 for a one-bedroom apartment that is less than 5 minutes away from the train, a Starbucks across the street. It has a pool. It has all of the amenities that, at least in my area, are being built on more of the luxury side
Yeah.
and allowing people. And the example they gave was somebody that works in DC, a young single woman who makes $48,000 a year and has found herself in a situation where she was able to move out of a home that she was living in with a relative, and move into housing. Now, while that housing doesn't require a mortgage, I think it's always interesting to look and see what people are trying to do to give somebody a leg up, in an environment where, like you said, Montgomery County is like an expensive area where a lot of people make a lot of money.
Very.
But
Yes.
yeah, giving somebody a leg up to have it reduced her commute by 45 minutes each way, to have this opportunity. So I always think it's very interesting, to just kind of see people getting creative with their thought process of what they're doing. But like you said, they've been doing it for a long period of time. I just wonder whether that model is going to kind
Yeah.
of spill over.
Well, we used to be involved with them. We provided some pool insurance for their loans, and then that really kind of went by the wayside. So they've had to retool their financing. But yeah, it's impressive that they're still active and coming up with new ideas and bringing some innovative solutions to the issue.
Yeah. On kind of like the investor side of things this week, I saw a number of articles. So maybe the timing is kind of right. We used to jokingly within TMC, we called it the Swerbinsky plan, because Rich had this idea. It's been probably 2 years ago now, where he's like, they just need to incentivize these people to like turn over their properties. And if done appropriately, he had this whole plan in place. Don't remember all the details. But I saw some articles this week that it almost seems like the time has come for investors to be at a point where they sell. Last 3 years, values up 35.5%, last five, 50.8%. Apartment construction is soaring, at least in some markets right now. What have you heard like amongst your clients and stuff? Hear anything related to like investors, kind of maybe smaller investors trying to offshoot some of the properties that they own?
Zero on that. But I do think it's interesting because I think that will be uh, one of those points that it happens very rapidly, right? I think there's still a lot of cash offers out there, and there's still a lot of investment buying. But I agree that there's got to be kind of a tipping point where, if there's any kind of weakness. I was just watching Mr. Schiller on CNBC about a half an hour ago, and he was saying that nationally, average wise, they think it's basically dead even. That there are some markets that are losing a little bit, and some markets that are gaining a little bit. If that turns around and the average is starting to lose, that yeah, you could see a large grouping of investors take some off the table because I get the feeling that much of the investment buying is not me buying one investment home, right? It's a business model, and the business model is going to want to hang on to some of its gains.
Right, right. Yeah, I would agree with you. In this article, it shared that the number of houses for sale right now are half of what it was pandemic. So
Yeah.
before the pandemic started, I don't think that number would really surprise anybody who's on this call. But I do kind of tend to agree that I think once the yeah, once it starts to happen, that there may be a mass exodus in that. We've seen that happen. We've seen that happen before. It's like if it doesn't make monetary sense to do it, people are going to stop doing it. And especially if they're incentivized in some way to do that. And, maybe that will allow some additional affordable housing for people to be back on the market to be purchased, which I think we all would agree is a good thing. So,
Well, certainly if their home values and they own a large number of these properties start to fall, that would be a market incentive.
yeah, I'm
A
out.
market induced incentive.
Exactly. Brought this up a little bit earlier. We were talking about it, and you used the word multi-generational. There are places, I know we've had them here in the Twin Cities for a few years, very specific markets that are building multi-generational housing, where houses are specifically made for that. But with the pandemic and housing costs, not necessarily the house itself, but the family involved in the house. Multi-generational housing has quadrupled to 59 million over the last 50 years.
Yeah.
And in some environments, we all know that, in other cultures outside the United States, it's very common. I mean, and actually it's considered the best living environment to have your whole family together, but not necessarily in the United States. Has it been that way in the past? And NAHB reported that 45% of all buyers would prefer to buy a multi-generational home.
That really surprises me.
It's a
Probably
lot, right?
not constructed as such, but I'm interpreting that to mean to live in a.
Living as such, correct. Yep. Living as such. Yeah. Yeah.
And I certainly think that so if you live in an area where it's a very high cost area, right? Let's face it, a lot of the workforce that has to be in that area that works in Starbucks and Best
Hotels.
Buy and all those, they have a serious challenge affording primary residence for just one family. So I think a lot of that occurs. It occurs probably mostly out at the edge of urban creep, and that
Yeah.
it's just going to expand, as we all know. Immigration is going to continue to rise, and they'll have housing needs, and they'll lean more towards that multi-generational. So it does interest me to examine what they mean about specifically built for that. So like mother-in-law, father-in-law, in-law suites, is that what they're saying?
It's like people are looking at that. I know that we have at least 3 developments here in the Twin Cities where they either build it's almost like an extra side attached onto the house. And I only know because my daughter has shared with me that I'm not doing that. So that's how I found out about it. It's like, that is not going to happen. But yeah, it does appear that there are some places where they're building almost like a separate apartment in the house, kind of like, the basement that used to be set up. We would run into this in the appraisal world quite frequently, where there's this stove in the basement and there's other things down there where it really is almost like built as a second unit.
Yeah.
So there is some focus on that. I don't know whether it's like what I would love to know more and might dig into it a little bit more to see, is it strictly cost that's driving it? Is it, people like me that are growing older that's kind of driving it, that they then want to be by their kids and their grandkids and all of those things. But yeah, so there is some of that out there. This article though was buying multi-generationally, not housing being done multi-generationally. So people just buying more as a family, which kind of goes back to the conversation that we were having a little bit earlier about, loans aren't plain vanilla and 1 or 2 borrowers and each one having one job anymore. It's like the, mortgage loan application looks maybe a little bit different right now than it has.
And I think it will just have to continue to evolve. I mean, it's just the the bottom line of housing costs have spiraled upward over the last 20, 30 years, to the point where now it takes two incomes to really finance a family and a house. Well,
Yeah.
unless we're going to have a serious change in terms of our marriage structure, there's not a third to add.
Exactly. Exactly. Well, that seems like a really great place to stop. We're at the bottom of the hour. I just want to thank you for hopping in, being willing to do this with me. For those of you on the call, you know MGIC, they've been a great partner of the Mortgage Collaborative we're rolling on, I think, close to 5 years at this point.
Yeah.
And so really appreciate you, always appreciate your insight, and thanks for
Absolutely.
everything you do with us.
Thank you
We
for the
appreciate
input.
you.
Very much appreciate it. Great talking with you, Faith.
Great talking to you too. Thank
Thanks.
you. See you
Bye-bye.
next week, you guys.